What's up guys, my name's Curtis and welcome to 5-Minute Finance, where I take personal finance topics and explain them to you in 5 minutes or less. A few months ago I made a video about analysis paralysis, which is when you get too caught up in the analysis portion of investing that you simply don't invest because that perfect situation isn't coming along. If you're interested in that video, I'll have it linked somewhere right around that upper corner. Now the other end of the spectrum to that is what's called action bias. In a nutshell, action bias is the propensity to take action with your investments as opposed to taking no action. This can lead new and experienced investors to take action when their investments when none is really needed. This often leads to buying and selling at the wrong time simply because the investor feels like they need to do something. I don't want you guys to see this video and think that you need to take no action with your investments whatsoever. Just make sure you aren't doing things with your investments just so that you feel more involved. There's nothing wrong with simply buying passive index funds and letting them grow long term. There's really only a couple reasons why I think you should try your best to avoid action bias, but they're very important reasons. To start off, I've talked ad nauseum on this channel that over the long haul, passive index funds outperform a vast majority of actively managed mutual funds. When you're constantly trying your best to beat the market, it very often causes you to take action that actually causes you to get worse returns. It's because of action bias that I tell people to be careful when it comes to buying individual stocks. See, when you're invested in some sort of passive index fund that fluctuates maybe 1% up or down each day, usually a lot less, it's really easy to just let that ride and see it grow long term. But when you're investing in individual stocks and securities that can have massive upside as well as massive downside, you're much more inclined to take action. And this chart, I'll leave it on screen for a minute, is a great depiction of what happens to, unfortunately, a lot of investors. They see this hot new stock that's been growing like crazy, but they wait a little while because they're a little bit skeptical. Once they realize how incredible this stock is, they buy in hoping for massive returns. Not too long after, there's an inevitable dip as stocks are constantly going up and down in the short term. They might eventually get to a point where they think the investment was a bad decision because it may have dropped a little bit, and they decide to just cut their losses and sell the investment. I know this is kind of a dramatic example, and there's plenty of people who win when it comes to single stocks, but the emotions involved in single stocks often cause investors to buy and sell at the wrong times. The emotions involved in individual stocks have a similar effect when it comes to actively managed funds, as those managers are constantly buying and selling to try to beat the market. The other reason I think it's important to avoid being overly active when it comes to your investments actually has to do with taxes. When you're constantly buying and selling investments, whether or not you're doing extremely well, you're going to owe regular income taxes on those gains in the year in which you sold. If you're able to hold on to those investments for longer than 1 year, you'll owe long-term capital gains tax on any investment income, which is much lower than traditional income tax. So even if with all that action you're taking, you are able to get a slightly higher return, which we've talked about statistically long-term is probably not going to happen, there's still a chance that the increase in tax owed might offset any additional gains you've gotten from all that activity and churning. Again, I do want to reiterate that when it comes to investing, absolutely some action is necessary. But I hope this video helped to explain why it's important to not overdo it. And don't simply take action with your investments just because you think you're supposed to. More often than not, simply letting your investments grow without touching them is the best way to go. If you guys enjoyed this video, it would really help me out if you gave it a thumbs up. If you're new around here and want to see more personal finance videos in the future, click on this globe right here to subscribe. And as always, hit the notification bell so you don't miss any new videos.